Welcome back to Marginal Thoughts. Great to have you with us. So, picture this. You've started your own business, it's incorporated, things are going well, money's coming in, fantastic. But then comes the big question, maybe one you're facing right now. How do you actually take that money out for yourself? It's not quite as simple as just moving cash from the business account to your personal one, is it? The choices you make here can really matter for your taxes, obviously, but also for things like planning your retirement or even whether you can get a mortgage down the line.
That's absolutely right. That money's sitting in the company bank. Legally, it belongs to the company, not you personally. So getting it into your own pocket involves specific processes and, crucially, tax implications. Understanding this stuff, especially when you're starting out, is key to avoiding some, well, potentially nasty surprises later on.
Okay, so today we're going to break down the main ways owners of incorporated businesses can actually pay themselves. We're talking beyond just grabbing cash. We'll look at the core options. Taking a regular salary, paying yourself dividends, or maybe having the company put money straight into your pension.
Yeah, those are the big three.
Yeah.
And our goal here isn't to tell you this is the best way, because honestly, there isn't one single answer. It really depends on your specific situation, your business, your goals. But what we can do is walk through how each one works, the pros, the cons, so you can start figuring out what mix might make sense for you, especially if you're relatively new to running your own incorporated business.
All right, let's dive into that first one then. Taking a salary. This probably feels the most familiar, right? Like having a normal job.
Exactly. Your company officially hires you. You become an employee of your own business. This means setting up a proper payroll system. So each payday, the company calculates your gross pay. Then it has to withhold deductions, things like income tax and contributions to government retirement plans, national insurance in the UK, or CPP contributions in Canada, that sort of thing.
And the company sends those deductions off to the government.
Precisely. They remit those amounts regularly. You get the net amount, what's left over, and then at the end of the tax year, you get an official summary, like a P60 or a T4 slip, showing exactly what you earned and what was deducted.
Okay, sounds a bit more involved than just transferring funds. So what are the big advantages of going down the salary route?
Well, there are several key ones. First off, paying those government contributions, like national insurance or CPP. That builds up your entitlement to future state retirement benefits. That's a really important piece of long-term security for many people.
Right, securing that future pension. What about benefits right now?
Good question. Taking a salary gives you earned income, and that's often necessary to create contribution room for your personal retirement savings plans, like RRSPs in Canada, for example. So you can put money aside personally, often getting a tax deduction for it. And here's a really practical point. Having that consistent, documented salary often makes it much easier to qualify for personal loans or mortgages.
Yeah. Lenders love predictable income, don't they?
They really do. That regular payslip history looks much safer to them than, say, fluctuating business profits. From the business's perspective, too, the salary you pay yourself is a legitimate business expense.
Okay, so it reduces the company's profit before tax.
Exactly. It lowers the company's taxable profit, which means the company pays less corporation tax. And importantly, you can usually pay yourself a salary even if the business isn't profitable yet, maybe in the early startup phase.
And because the tax is taken off as you go, you're less likely to get hit with a huge personal tax bill at the end of the year.
That's a big plus. Tax is withheld throughout the year, so your year-end liability on that salary income should be mostly covered. It definitely helps with personal budgeting and avoids that scramble for tax money later.
Okay, lots of good reasons there. But there are always trade-offs. What are the downsides to taking a salary?
Yeah, there are definitely costs and complexities. A major one is those government contributions, national insurance, or CPP. The tricky part is both you as the employee and your company as the employer have to pay them.
Oh, right. So it's like a double hit. The company pays an employer's share on top of what's deducted from your gross pay.
Essentially, yes. That employer contribution is an extra cost to the business, which you don't have with dividends, for instance. Also, generally speaking, salary income is often taxed at higher personal income tax rates compared to dividends. We'll get into why shortly. And then there's the admin. Running payroll isn't hugely complex, but it requires diligence. Regular calculations, meeting remittance deadlines. If you miss those deadlines, you can face penalties.
Penalties. Never good. Okay, that leads us nicely into the second main option. Taking dividends. How does that work?
Dividends are fundamentally different. They aren't a wage. They're a distribution of the company's profits to its shareholders. And the absolute key thing here is Dividends can only be paid out of profits after the company has already paid its corporation tax.
Okay, so the company makes a profit, pays tax on it, and then dividends come out of what's left.
Exactly right. That pot of after-tax profit is sometimes called retained earnings. The process usually involves formally declaring the dividend. Often that requires a quick board resolution. Even if you're the only director and shareholder, it's good practice. And then you need to issue the right paperwork, like a dividend voucher or a T5 slip, for your personal tax return.
So if the company's already paid tax on the profit, how does that affect my personal tax when I receive the dividend?
This is where it gets interesting. Generally, dividend income is taxed at lower personal rates than salary income. The tax system usually provides some kind of credit or allowance to reflect the fact that corporation tax has already been paid on those profits. This mechanism aims to prevent the same profit being fully taxed twice. That lower personal tax rate is often the main attraction of dividends.
Lower personal tax, that definitely sounds appealing. What other advantages are there?
A big one is those government contributions we talked about with salary national insurance or CPP. With dividends, neither you nor the company has to pay those. That's a direct saving. Plus, in many tax systems, there's often a specific tax-free allowance just for dividend income each year, on top of your regular personal allowance.
So potentially less tax overall, no extra contributions, and simpler admin too.
Generally, yes. There are no regular payroll calculations or remittances needed. It's typically more about getting the paperwork right when you declare it and handling the year-end reporting for your personal tax.
Okay, sounds great on the surface. So what are the catches? Why doesn't everyone just take dividend?
The biggest limitation, and it's a fundamental one, is that you can only pay dividends if the company has sufficient retained earnings, meaning enough accumulated after-tax profit. If the business hasn't made a profit or it has past losses wiping out current profits, you legally can't pay a dividend.
Right, so if the business has a bad year, you can't just pay yourself a dividend anyway.
Nope. Salary you potentially could, but dividends,
Mhm.
no profit, no dividend. Also, remember how salary is a business expense that reduces company profit? Dividends aren't. They come out after profit has been calculated and taxed, so they don't reduce the company's corporation tax bill. And because they depend entirely on profits, your dividend income can be much less predictable than a steady salary.
And what about those other things we discussed with salary, like building pension entitlement or getting loans?
Good point. Dividend income typically doesn't count towards building entitlement for state retirement benefits. Nor does it usually create room for contributing to personal retirement plans like RSPs. And yes, as we touched on, some lenders might view dividend income as less stable than salary when you're applying for a mortgage or loan, which could make qualifying harder.
That predictability factor again. Is there anything else people need to be careful about with dividends?
Yes, there's a really significant risk, especially for people new to this. It's taking money out when there isn't actually enough profit to cover it legally as a dividend. If you just transfer cash to yourself without the profits and the proper declaration, tax authorities could deem it a director's loan. That's money you technically owe back to the company. Or worse, they might see it as undeclared income, leading to interest and penalties.
Ouch. And there's another issue too, right? About planning for the tax.
Absolutely critical. Because tax isn't withheld when you take the dividend payment, you are responsible for saving up to pay the personal income tax later on. This catches so many people out. We should definitely talk more about avoiding that trap.
Yes, let's circle back to that. But first, there's that third option. Company pension contributions. How does that fit in?
This is less about getting money in your pocket today and more about building wealth for retirement in a very tax-efficient way. Instead of paying you directly, the company makes contributions straight into a registered pension plan set up for you.
How's that different from me just putting money into my own pension from my salary or dividends?
The key tax difference is when the benefit happens. When the company makes the contribution, it generally doesn't count as taxable income for you personally in that year. So your immediate personal tax bill doesn't increase because of that contribution.
Okay, no personal tax hit now. What about the company?
For the company, these contributions are usually treated as a allowable business expense, much like a salary. So they reduce the company's taxable profit, lowering its corporation tax bill. And another bonus. Often, there are no employer national insurance or CPP contributions due on these pension payments either.
So the company gets a tax deduction and I don't pay income tax on it right now? That sounds very efficient.
It can be extremely tax efficient, particularly if you're earning a good amount. And here's a really powerful aspect. The amount the company can contribute isn't necessarily tied to the size of your salary. It's usually limited by a separate, often quite generous, annual pension contribution allowance. For example, in the UK, it can be up to £60,000 a year currently, subject to certain rules. This means even if you pay yourself a relatively small salary and take mostly dividends for your living expenses, the company could still potentially put a very substantial amount into your pension, getting that tax relief.
Wow, okay. So you get the flexibility of dividends for income, but still manage significant retirement saving through the company. That seems like a best of both worlds scenario for some. What's the catch?
The main drawback is pretty straightforward: access. You generally can't touch that money until you reach a certain age, typically 55 or older, sometimes later depending on the plan rules. So it's purely for the long term. Doesn't help you pay this month's bills.
Right, got it. Okay, so we've looked at salary, dividends, company pension contributions. Now, the million-dollar question, which one saves the most tax overall?
Yes. And the answer is, it depends. It's rarely a simple calculation. To figure out the true tax efficiency, you need to look at the total tax impact. That means considering the corporation tax that the company pays plus the personal income tax you pay when you receive the money.
It's not just about which one has the lower personal tax rate on paper.
Not necessarily. Tax systems often aim for something called integration. The idea is that, theoretically, the total tax paid on £1 earned by the company and eventually paid out to you should be roughly similar, whether it comes via salary or dividend.
But theoretically often means it doesn't quite work out perfectly in reality.
Exactly. Integration isn't always perfect. Depending on your total income level, the specific tax rates and allowances in your country or region, sometimes taking dividends is slightly more tax efficient overall. Sometimes salary is. It can change year to year as tax rules shift. Nailing the exact optimal split often requires running the numbers for your specific circumstances, maybe with an accountant.
Okay, so the pure tax answer is complex. But you mentioned earlier there are other really important factors to consider beyond just minimizing the immediate tax bill.
Absolutely. And often these non-tax factors are just as, if not more, important in making the right decision for you. Think about your personal needs and goals. Do you need that predictable income each month? Is maximizing your retirement pot the absolute top priority right now? Are you planning to apply for a mortgage soon? Your answers really shape the best strategy.
Those real life needs.
Exactly. And look at your business too. Is it consistently profitable? Or does cash flow swing wildly? Can the business realistically handle the fixed cost of payroll every month? And be honest about your tolerance for admin. Are you okay with managing payroll? Or does the simplicity of dividends strongly appeal, even if it means slightly less predictability?
It feels like a balancing act between all these different pieces. Is there a common approach people often take to try and get the best of several worlds?
Yes. A very common strategy, especially for established businesses, is to use a combination. Many owners pay themselves a relatively small regular salary, enough to trigger those national insurance CPP contributions for state pension entitlement, and maybe enough to utilize their personal tax allowance and create some RSP room. Then, for the rest of the money they need to draw from the business, they take it as dividends. This aims to get the basic benefits and stability of salary while taking the bulk of the income through the potentially more tax-efficient dividend route, assuming the company has the profits to support it.
That makes a lot of sense. A bit of salary for the foundations, then dividends on top. Now, let's go back to that risk you mentioned, the dividend trap. Can you unpack that a bit more? It sounds like something people really need to watch out for.
Oh, definitely. The dividend trap is so easy to fall into, especially when you're starting out and maybe haven't quite got your head around the separation between company money and personal money. It happens when you treat the company bank account like your personal ATM. You need money, you transfer it, maybe without thinking too much about the formalities or the tax consequences down the line.
Just taking drawings as you need them.
Exactly. Your accountant might later tidy this up by declaring those amounts as dividends on paper. But here's the problem. When you took that money, no personal income tax was set aside. The company might have paid its corporation tax, but you still owe personal tax on that dividend income you received throughout the year.
And if you haven't been putting money aside for that personal tax bill.
And tax time rolls around, and suddenly you're facing a surprisingly large personal tax demand.
Yeah.
And you might not have the cash ready to pay it. This can lead to late payment penalties, interest charges, and a really stressful situation trying to catch up while still running your business. It's a horrible cycle to get into.
Yeah, that sounds incredibly stressful. How do people avoid falling into that trap?
The absolute key is changing your mindset from day one. You have to understand, the money in the company account is not fully yours until all the taxes, company and personal, have been accounted for. Practically speaking, it means planning. Estimate how much personal tax you'll likely owe on the dividends you plan to take. Then actually set that money aside. Maybe transfer a percentage of every dividend payment into a separate personal savings account, specifically labeled tax. Or, as we mentioned, consider using salary for at least part of your income, as the tax gets withheld automatically. That takes the discipline out of your hands to some extent.
That's really practical advice. Automate the saving or be disciplined about setting it aside. So, pulling all this together, it really does seem like there's no single magic formula for paying yourself.
Absolutely not. There is no one-size-fits-all answer. The best mix of salary, dividends, maybe pension contributions, it's unique to your business, your financial goals, your personal tax situation, and even where you live, because the rules vary.
And planning seems to be the crucial first step.
It really is. Taking the time to understand these options before you start taking significant amounts of money out can save you a lot of tax, a lot of stress, and help make sure the way you take your income actually supports what you want to achieve financially.
So for you listening, the takeaway here is to really think about your priorities. What's most important right now? Is it that steady income? Pushing hard on retirement savings? Keeping things as simple as possible administratively? Or minimizing the combined tax bill?
Yeah, weighing those up against how salary, dividends, and pension contributions work is the starting point. That's how you begin to tailor a strategy that actually fits you and your business.
This has been incredibly helpful in clearing up what can feel like a really complicated area. So, to quickly recap, deciding how to pay yourself from your incorporated business means weighing up tax for both you and the company, your retirement plans, cash flow needs, and how much admin you want to handle. Salary gives consistency and builds some benefits, but has higher contributions and potentially higher tax rates. Dividends can be more tax efficient personally and simpler, but depend entirely on profits and require careful tax planning. Company pension contributions are great for tax-efficient long-term saving, but lock the money away. Often, a blend works best.
Understanding those trade-offs is fundamental to making good decisions right from the start and avoiding those common pitfalls.
Absolutely. So as you move forward with your business, here's something to think about. How will you consciously manage that balance between taking the income you need to live comfortably today, while also making sure you're setting aside enough for taxes tomorrow and strategically building funds for your longer-term future? It's a balancing act every business owner navigates.
It really is. Finding that sustainable balance is key.
If you found this discussion helpful, we'd love to hear your thoughts or maybe how you approach this. Let us know in the comments below. And of course, if you want more clear explanations of topics like this, make sure you subscribe to Marginal Thoughts. Thanks for tuning in.